joins us now. Jeff, explain your rationale there. 7%, what would require that, and when do you see that actually happening?
So the real federal funds rate, adjusted for inflation, is the measure that gauges the stance of monetary policy, the extent to which it's restraining demand growth and spending growth. And that's really only at about 0.5%, maybe 1.25%, depending on how you measure it. And the historical record is pretty clear that for inflation as high as it is now, you would need 2 to 4% real federal funds rate to bring inflation back down to 2%. And so that on that basis, they're probably going to have to go up unless inflation comes down significantly and pretty rapidly, and by that mechanism increases the real federal funds rate where it is now in nominal terms. So that's the basis on which I say that.
It appears that there's some kind of theme or threat of disinflation out there, and of course we had the softer than expected CPI print. But you believe we need to see a lot more on that front to give any kind of pause or any kind of potential cut even in the future.
Yeah, the June CPI print was better than expected, softer. The core number, 1.9% month over month at an annual rate. That was really good news. But it's just one number. Before that, going back 6 or 8 months, every number had been on a month over month basis over 4.75% at an annual rate. So it could be a head fake. Well, we've seen head fakes before, so we need to wait and see. Having said that, I mean, there's a lot of hope for a kind of a housing disinflation that's in the pipeline because of lags in the way rents are figured into the CPI. But if you look at housing market's firmed a lot in the last few months, and it looks like that housing disinflation in the pipeline could be just transitory, and we could see firming shelter costs later in the year and early next year. So it's not clear how far this trend's going, how fast it's going, and whether it's going to get down to 3%. And then on top of that, you've got a hot labor market and wage growth that's still very inconsistent with 2% inflation. It needs to come down a bunch.
All that said, between now and the next meeting, we're going to get, a couple of CPI reports, a couple of employment reports. I mean, they're going to have a lot, and Jackson Hole. So there's going to be a good amount data perhaps coming in between now and the next meeting, right, Jeff?
Yeah, a lot of data. It'll be, as you said, two big inflation reports. You're going to get the PCE for June at the end of the week, and then 2 months worth for the next cycle. At Jackson Hole, they admit the data. They don't collect any. They will have a lot to go on. And I think we'll know better whether this is an emerging trend or not.
Do you think they actually need to engineer a recession to stop hiking at this point? Is a recession a prerequisite to kind of change the trajectory here?
I don't think so, but the historical record makes it look like it's really likely that if they raise real rates enough to slow down demand growth, enough to slow down inflation, that it's going to have repercussions for the labor market that are kind of nonlinear, that just sort of spiral the labor market into a hole. And that's been the historical experience. And I'd be surprised if it doesn't play out that way this time, too.
What about the balance sheet? What about, tightening? What about the reluctance, perhaps, of some banks to lend? Do you think that's having any contraction or impact?
No, the historical record I talked about has the same thing happening. Whenever the Fed tightens, there's a pullback in lending. There's a tightening of credit standards. You see that every time. And so that data sort of, kind of bakes in that effect, if you know what I'm saying.
And the balance sheet, too? You don't see that much of an impact?
I don't see the balance sheet as being a big player in this. I mean, they're reducing it at, $65 billion a month, and that's not a lot, and it's going to take a while to have an effect, and they're not going to vary the timing of that. It's pretty predictable, so markets have baked in the implications for supply of, MBS and Treasuries, so I don't see a big thing coming in.
There's a lot of debate about the lag effect and what's yet to really materialize, whether it be just the fiscal stimulus that's out there that's still floating around, whether it's the pulling back on lending, whether it's wage growth, whether that's fully materialized at this point in time. How do you see those pressures kind of working their way through, say, in the next 6 months to come?
Yeah, I don't see lags as a big factor here, at least not compared to the past. I think Governor Chris Waller, made some really good points about lag effects. So the moves that began last March were telegraphed, 6 months in advance. And you saw the 1 year and the 2 year yields pop up well before the hiking actually began. So there's sort of less of a lag, really,